Again, good morning and welcome to the 8th Annual Inland Marine Expo, live and in person once again. I'm John Schulberg. I'm the editor of the Waterways Journal, and on behalf of the Waterways Journal, I want to welcome you here today. Also, I want to thank all of the sponsors of IMX. They're listed out on the trade show floor. The trade show floor will be open today from 10 until 5, tomorrow from 10 until 3. So get over there and check out the exhibitors. A lot of people put a lot of work into getting here and re-inaugurating this the in-person event again. So thanks again for coming. My job this morning is pretty easy. I'm going to introduce to you someone who you probably already know. Ken Erickson is Senior Vice President of IHS Market, and Roger Bernard is Senior Policy Analyst for IHS Market. They're about to present a whole lot of data for you, so get ready. Here they are. Thank you.
Well, good morning, everybody. Good to see you. And as Greg said, man, to get in person and to see faces and teeth and smiles. Last night was energizing. You didn't get to go to the reception. It was very exciting. Good to see everybody. Handshakes are back. Hugs are in vogue again. And rooted in resilience. What a great theme. And you know, this industry, year after year after year, resilience has always been the moniker of this industry. And to be able to be ready to go and move forward in any kind of situation. And this last year, of course, really did test that resilience. But you know, as a steelsmith will do, or a blacksmith will do, it's tempered resilience. I've been reading a book about that, how they go through as a kind of a leadership book. And you know, it takes work, it takes pliability, but it's consistent. And in the end, you start with a chunk of metal. In the end, it's something of beauty or something of use that goes through this. So rooted and resilience is exciting. Well, for us, we're really excited. I'm Ken Erickson. This is Roger Bernard. Hope that wasn't not going to confuse you too much on that. So we're very pleased to be here. And it was 2 years ago at this event that it was announced that we were sold to our new parent company, IHS Market. And actually, we heard the news just before we were coming over here, and someone was already breaking the story for us at this event. I don't know if it was Dave, I don't know if it was Greg, but somebody was out there breaking the story. We didn't even get a chance to hardly tell anybody, and people are already congratulating us on our new ownership. We've been very excited where we are. It's a great company that we get them, they get us. They are certainly, we as a team are very focused with our clients. It's a fun place to be. Our former owner had a very different construct. And quite frankly, our former owner is the world's largest conferencing events exhibition company in the world, as well as a major publishing company in the world. Needless to say, we're very happy with IHS Market this last year. I'll say this, I think this is probably the first major industry event in the United States. Now, I'm kind of biased, but I know from our former owner, they haven't had any live events yet. And they'll have some later in the summer. So to Spence and to Jennifer and to the IMX team, congratulations to pull off this event and to work with the local authorities. It's not an easy task, without a doubt. And I think we all feel safe.
Yes.
And it's very exciting.
And frankly, from my perspective, it's good to see pants again. Yeah, those of you on Zoom calls are on. Oh, yeah.
I've been wondering about Roger all these last years. So glad to see that you do over here again. So
I do.
As part of IHS Market, we are very customer client focused. We take a large, vast amounts of data, transforming it into a knowledge set of information that we start to put together into forecasts and to look into the future and try to understand these different relationships that we're seeing in the various aspects of the economy, in the areas of policy, politics, environment, boardrooms, a number of areas that we pull together. There's about 10 different areas within IHS Market that we get to engage in, and we come out of what's known as the agribusiness side of IHS Market, but we used to do a lot of work because we remind people when you're trading grain or you're trading coal or you're trading steel, you're not trading those really. You're trading freight. And so for us and our agribusiness group, we look at the transportation sector very closely. And because we know that's where the real value starts to come alive for commodities in that marketplace there. We get to work very closely with our maritime and trade group. We get to work very closely with the peers that has a great amount of data on movements of commodities around the world, as well as our global trade atlas team. We work very closely with our automotive group. You may have heard of Carfax. That's one of our companies. And quite frankly, what's so important about that is, and also together with our energy group, as well as with our, they just formed a new group that's on climate, sustainability, and I forget the other letters. Yeah, it had 3 letters in that 3-letter acronym, so I don't know what the third letter is. We look at those very closely because a lot of our analysts are looking at a number of areas. You take our corn analyst, for example. She looks at that Carfax data and she wants to know how many new cars are coming online, what's the fuel efficiency of that fleet that's out there today, what's the penetration rate of the electrical vehicle? Because you know what, that goes right into that corn balance table and impacts the ethanol line. And we're seeing less ethanol as a result of better efficiency, more modern cars, and electrical penetration. Now, we may have 2 to 3% electrical vehicle penetration, and it's expected to grow rather considerably as we go over the next 2 decades here. But that's important because that means there's going to be less corn going into an ethanol plant, and there'll be more corn available for someplace else. Or our farmers may have too much corn available in the marketplace here. And so what's that next transformation that will come? And there's a number of areas. It's just one illustration. We've come into a great company around those lines.
And I think it's maybe even a more simplified approach to look at what we do is try to take in all of that information that Ken is talking about and connect the dots and tell you a story of how you get from point A to point B with all of these inputs and tell you not just about the inputs, but what they mean and what they're expected to mean. And that, I think, really, sets us apart from a lot of the other spots in the industry.
And it's a good way to connect the dots. That's transportation. Let's get into it here. We think about this. First, we'll just give you a couple of slides on the macroeconomic outlook. We know that 2020 was not a very exciting year macroeconomically. As we look around the world and we see what's taking place on that consumer front, and just the immediate pullback that we had, and we're going to show this on a quarterly basis, this real GDP, gross domestic product, you would see that sharp decrease for a couple of quarters there that were so significant that was taking place. And then you see, of course, the industrial production followed right along, as well as the real exports that would follow along. Just a collapse of the economies. But yet there's that rooted in resilience that we saw, the great snapback that we've got underway here. And quite frankly, the table on the right here, looking at these real gross domestic product around the world, it's actually dated. And I tried to pull the most recent one. I was looking this morning, and we've updated our numbers, especially for the United States, and we're showing even stronger growth for 2021 that's closer to like 6.7, 6.8% GDP growth. And next year we're in the high 4% GDP growth. And quite frankly, that's something that will continue to evolve as we go forward with a number of things as the consumers are still have a lot of cash in hand. We've had a lot of government money that has come into them. And as they start to come back, look, without our masks, and we're seeing the economy come back, the folks, depending what hotel you're at, we had breakfast this morning, God bless the waitstaff. They were working their tails off with just a skeleton crew of people. I shouldn't use that word skeleton with COVID, I apologize. But you got this unfortunate situation trying to get people back to work. And that's a challenge. Everywhere we go and talk to our clients, we don't go anywhere. We just talk to them on the phones and Teams. We just hear the constant burden of not being able to hire people. And that's one of the Achilles heels that we've got in this economy right now.
Yeah, and as we look at that, and that's where a policy implication has come into play. Of course, when you get to, some of the lawmakers in Washington insist that those expanded jobless benefits that go into September, they're not a factor. But I point to Janet Yellen, the Treasury Secretary, who said it's not a major issue. For Janet Yellen to at least identify it as an issue, that tells you it is an issue. But 21 states have now taken action. They're going to pull out of those expanded federal jobless benefits early to try to coax people back from the unemployment lines and getting them back into a job. The other thing I think that goes into what is happening for the consumer is during the course of this pandemic, they have paid down credit card debt by an immense amount. I think, if I remember right, the data over the last year has shown only 1 to maybe 2 months that credit card use actually expanded. Otherwise, it has been contracting. So you have, and your savings rate has been astronomical. So you've got a consumer that's sitting on quite a bunch of money. They're sitting on quite a bit of more spending power in their credit cards, because of course, that's a way that they can use to make bigger purchases that they maybe don't have the cash for, but are confident enough in their repayment ability that they will break out that plastic and start using it a little bit more. So those are some of the figures I think that are also going to be important to watch moving forward. Because if we start seeing those credit card balances go up, I think that's an even bigger sign of consumer attitudes and consumer confidence than the readings that measure that specifically, as we look forward.
Yeah, and meanwhile, when we start thinking about this recovery schedule here, and really, you look at the different parts around the world, and we start to see when the level of GDP gets back to pre-COVID levels around the world. And quite frankly, I think the one I take umbrage on is down there, Q3 for 2021 with India. I think just how decimated the place is, unfortunately, and I think the numbers are not being fully reported, especially at the lower caste system in India, that we would see the number of deaths. And I know more people who died in India than I know who passed away of COVID in the United States. And that number keeps ramping up every day in India. We have from our church a number of missionaries, and 8 of our missionaries that we support over there are no longer alive with us today because of the bad health care they've got, working with the low caste system. But you look around the world here, some of these places, out to Q1 2025, now Argentina, it may not be COVID, it's just their self-undoing of things or continuation of bad policy. We just got together with a client the other day who came in the office. He's Argentinian, just returned from there. And he says it's a basket case, that they're wanting to knock off the front end of life and the back end of life, and they've got no one in the middle to try to help support and raise the income of the country, and so they're putting in programs to freeze exports. Now, that's good for the United States, because that brings business back to us here. If they're freezing, say, meat exports, that starts to also start charging more taxes on their other exports. They're very dependent on exports, on their grains, and so they really encourage value add, so you get more of your soybean meal, soybean oil exports that you would see out of there. But you look at this consumer is going to be the important part of this. We start to see these places begin to open up. Japan, they've got quite a squabble going on with its Olympics this summer that was delayed from last year. And they are facing a big hit if that doesn't take place here. And that's something that's going to be very challenging as we go forward here. What does this look like to open the economy as we go forward here?
Yeah, and you even have the U.S. now saying not recommending travel to Japan. So right there is another sign these Olympic Games, I think, may still well be a question mark if they do indeed take place at all. And that's a big hit for Japan's economy. Already doing it without overseas attendees coming in is going to be a hit. But if you end those games and don't do them again, that puts Japan into a much more difficult situation. You look at Europe, looking at getting into 2022 before they get back to pre-COVID. Therein lies the issue of having in the Eurozone, 27 some odd countries or more. It's hard enough for 50 states, let alone 27, 30, 40 countries that are part of the mix. And each one of them is progressing at their own pace, and that contributes to a much slower recovery in Europe overall.
And we'll come back and talk about China a bit more as we get into the material here. But China certainly has come back, regardless of what you might think was going on in China. Certainly a lot of news in the last few days here about what's going on in the lab and other things. But importantly, if we look at African swine fever, has all but gone away somehow magically, and they're hopefully bringing those hogs back to nearly 90% of what they were pre-African swine fever. African swine fever is mortality, 100% mortality for a hog. And so for them, China, you take all the countries in the world, besides China, add up all the hogs, you still don't get to the same herd size that China has for pigs. Take that and think about that. They've got about 750 million pigs in that country. And they got to feed them every day. And they're getting away from backyard feeding, and they're moving into a high-value, high-protein diet, which means they need soybean meal, they need corn, they need other ingredients. And they've been buying the daylights out of all those ingredients as we go forward here. And they're trying to put programs in place. For them, this is national security. Pork is national security. I happen to agree. I had bacon this morning. That is a national security item to me. So I don't know about y'all. I get that part, okay? And pork chops, good pork chops. I'll stop training. But they're looking at what's going on around the world here, and it has a direct implication for this industry. And what you do every single day is very important. We'll start to unpack that. Roger, you start thinking about policy and trade.
Right.
It is policy and trade at the heart of everything that's happening.
Yeah, and we thought we had a partisan Washington under the prior administration. Well, folks, it hasn't gotten any better, okay? There are still some very deep political divides in Washington, and where that comes into play is that prevents a lot of activity from taking place, or it allows the use of that third point, something called budget reconciliation. I'm sure you've probably heard of this. It's a procedure that allows the party, in this case the Democrats, that is in power, to use budget reconciliation. This bypasses the normal requirement in the U.S. Senate that you have to have 60 votes to get legislation moved through the United States Senate. Well, we're at a 50-50 split in the U.S. Senate with Vice President Harris casting ties in the event that those take place, and she's already had to do that. So when you're at 50-50, getting something that requires 60 votes means they've got to get Republicans on board. With what we have seen coming out, the COVID aid package that was approved in March, the proposed infrastructure and social spending packages totaling $4 trillion, that's trillion with a T.
How do they spell infrastructure these days?
Well, infrastructure, it's almost easier to tell you what isn't considered infrastructure as opposed to what they are specifying is infrastructure in terms of that proposed legislation. But that narrow Democratic control in Washington has resulted in us getting a lot of things moving through. If they can get it with a simple majority, then we're seeing activity. But when it comes to needing more than the 50 votes Democrats currently have in the Senate, it's very difficult. Even on the House side, with a very narrow majority of just a handful of seats, that means also that the Democrats can lose only just a very few votes if they're wanting to get certain packages and provisions through. So this sets up the stage of why we're seeing what we're seeing unfold in Washington. We've got Republicans are playing the loyal minority and the loyal opposition right now as these things are unfolding. But we're going to come to a point fairly soon to where the legislative activity overall is just going to virtually come to a grinding halt, and that's because of those 22 elections. History tells us that, when a party changes in the White House, the sitting president of that first party, in that first midterm election loses seats. Well, with a 50-50 split in the U.S. Senate, you can see that's a pretty dicey thing for this administration. That's why they're focusing their attention on getting the COVID aid plan through in March. They're trying to get this infrastructure and social spending plan through now, but without the prospect of losing control of either chamber. I think it's going to be a tall order for the Republicans to retake the Senate, although they're going to be targeting a handful of seats that'll become a lot clearer in the coming months. But they will be targeting some of those seats in a bid to regain. They have more seats up to defend than Democrats do in these midterm elections. So the onus is on them to put good candidates forward, or to have Democrats come up with candidates with sitting Republicans that can be defeated from a Republican perspective, at least, if they have a hope of regaining that chamber. On the House side, I think it could be very dicey for Ms. Pelosi to retain that. We are seeing those infrastructure talks continuing. The administration has lowered their offer from 2.25 trillion down to 1.7 trillion, having taken some broadband and bridge things out of it. I know for Canada folks in Memphis, they're not liking to hear that with a small crack appearing in a bridge on I-40.
It ain't no small crack. It was a complete seven. Yeah.
And the Republicans have come back with a $568 billion plan. A lot of Democrats rejected it out of hand, saying that's not even in the ballpark. You're not even playing right. You're going to see another offer coming from the Republicans probably in the next 24 hours, something like that. But it's not going to get up to that 1.7 trillion mark that the Democrats and the White House are talking about. That, I think, is probably going to send that infrastructure package forward using budget reconciliation. You know, bridging the gap between $1.7 trillion and $568 billion is no easy task. And a lot of that, again, is dictated on this broad definition of infrastructure that is put in that package. There's another item that has come back to life in Washington. It's called earmarks. Actually, though, the new term is member-directed spending, just like the garbage man is a sanitation engineer, okay? This is the new thing, member-directed spending, and they get very irritated if you call them earmarks. You had almost 2,400 of them for the surface transportation bill on the House side, and now you're getting rumblings out of the Senate where Pat Leahy, who is 81 years old and is already indicating he's going to seek another term in the U.S. Senate. He is giving signals he may not allow an equal number of earmarks from Democrats and Republicans. So you're starting to see some jockeying going on, even though the Republicans have not adopted bringing back the earmark. They have, in essence, brought it back because they've made the request. I mean, you know, the old line, take pie when pie's passed. If you get an opportunity to do member-directed spending, then why not take it for your constituents?
Well, and Roger, the earmarks had served well in the past. They were a vetted program. They were researched and gone through and looked at. And in some ways, these can be very beneficial programs for targeted infrastructure projects to get completed here. Otherwise, we had a ribbon of asphalt poured over the country starting back in the Obama years and coming on through. We need to get that brick and mortar put together here.
Yeah, that's exactly it. So when we look at the administration's budget, that comes out this Friday, this is going to lay out a lot more detail of what exactly is going to be in this infrastructure plan and what exactly is going to be in this social spending plan. That's really, I think, where you start to see the rubber hit the road. And that comes in this full administration budget for fiscal year 2022 that starts October 1. The House has set a goal of trying to get their portion, all 12 of these annual spending packages that have to be approved in order to keep the government functioning. They want to get that done this summer. Of course, there's the August congressional recess when, you know, really nothing happens in Washington. Lawmakers are out of town. You can take your hands off your wallet because they're safe at least for a few weeks. But they're going to try to get that done before that August recess. Then it becomes a matter of how can they mesh everything together and get the House and Senate both to agree on something. I still think you're going to probably end up with a series of what they call mini buses, okay? And it's not the short bus that picks up kids and goes to school. It's another name. Instead of doing a big omnibus package that covers all 12 of the spending bills, they break them up into smaller pieces, 3 and 4 bills in a chunk, and they call those mini buses. It helps get those through as opposed to, forcing lawmakers to read thousands upon thousands of pages. And I'm sure every single one of them has read every single page of every single spending bill that they've ever voted on and approved. I'm sure of that. Wink, wink, nod, nod. Okay? So this is what we're going to see probably, is getting these mini buses put together, packaging things up to try to get things off so that we do not have a government shutdown. I still think odds are you may even see something happen of at least a temporary spending plan to keep us going after October 1. There's talk of tapping that harbor maintenance trust fund in order to get some things done on the infrastructure side. That's $10 billion sitting there. Now, of course, we're talking about hundreds of billions and trillions of dollars. $10 billion doesn't sound like a lot of money, does it? But it still is real money, and that could be deployed as part of all this.
And we know, Roger, if you spent $6.2 billion for the inland river system, not only would you get the 50-foot draft and lower miss, which is undergoing right now, by the way, but you also get all the locks repaired, or you get all the 7 major ones upriver, expanded to double locks, 1,200-foot locks. You get all kinds of other work that gets done to support the system. $6.2 billion, and you get a return of almost $72 billion on that. It's a massive increase across the economy, and then all the economic benefits that come to keep that competitiveness here. That's a very important part that we're trying to address. How do you remain competitive in this environment?
Yeah, and that's I think very important too, especially when you've got countries like Brazil that are investing in an infrastructure. Right now, Brazil relies 65% on trucks to haul ag commodities to exported locations or to haul them to along the Amazon, to get them onto river traffic, to get them to export ports. Only 15% of their infrastructure use is on rails. They're trying to switch that around and improve that. They're also doing it with an eye on climate change, because that will take the equivalent of around 1 million tons of carbon out of the air if they can boost that use of rail and reduce the amount of trucks that are used. So our competitors overseas are not sitting back and just watching the U.S. and try to update its very much needed infrastructure fixes that hopefully will be a part of this package. So let's hope that infrastructure really is in the infrastructure package. But I can also tell you that things like rural broadband are going to be another very important thing. I mean, it's great having the internet, but if you don't have the speed to access it, it's very frustrating. It's kind of like having a 20-year-old planter with a WD-45 Alice Chalmers. Okay, yeah, it's really nice to look at, but you really can't use it. Okay, so getting rural broadband is something, and I know that even gets into the transportation sector, helping out with river traffic connectivity, etc.
It does, and certainly in that infrastructure, you've got Amtrak Joe, who loves Amtrak, and he wants to expand that footprint. I love trains too. But what does that do for our economy? What does that do to move freight and to help our competitiveness? And where can we be putting some of that resources to really encourage that as we go forward here? But it's a good segue, thinking about a very efficient system, thinking about how you're already carbon favorable as an industry. You think about moving on the inland waterways, just the benefits that you bring. And as we survey you every year for the annual Barge Day Profile Survey, thank you. We appreciate your input. We appreciate you participating in that. These last 2 years, trying to get them finalized with the number of folks to try to have staff to complete the surveys for us. Thank you. It was a little bit later than we wanted this year, but we're going to try to sharpen that pencil for next year as we go forward. But in overall, your fleet, you operators in here, you owners of barges, it shrunk 1%. It's that sort of green line, solid line that is on the right axis there that you're closing in just a little over 22,000 barges, dry opens, dry covers, and tank barges in the system out here. And that drawdown was really associated, remember last year going into mid-March, the phrase that everyone heard was, out of an abundance of caution? Well, if you're holding open fleet or you move coal, out of an abundance of caution, please watch these next few slides very carefully and don't hurt yourself because they're not pretty. Coal has still got a lot of downward momentum here, despite the head fake we have in the marketplace today for coal. And we'll get into that in a moment here, but we see that the coal really led to the dropping of that open fleet, much needed to, and we saw that the covered fleet is closing in on 13,000 barges. Through a number of, there's been some new orders last year, we'll look at some of these here, but as well as some, perhaps some fine back that we had in the fleet out there. And then the tank fleet was a little bit smaller, and there's very good reasons around that as we go into it. But again, out of an abundance of caution for you coal people, that chart on the right is a long-term challenge, and this is commodity movements month by month on the river system. And if I should have probably put some red circles on here to show you, there's some lag effects that we saw in movements last year, especially on total movements. It actually is a bit more immediate. So when I get to the chemicals and such, you'll see the lag effect. But you can see here where we took a big hit last March, April, May, June, and then it wasn't really until the fall we started to see some of that traffic coming back on the river system here. Coal's got a little bit of a good story here. It's very competitive relative to natural gas. We've drawn down some of the supplies at the utilities, and we've got a good export market here on the thermal side of things. But again, don't get yourself caught into a head fake here, because what will happen with high prices, people want to come in and invest, and they want to be able to expand in those areas. And then what happens? You get oversupply. You just can't go open mind and try to run it for a little while without having a long-term path on that way. And that's maybe one of the challenges that we can see, some more oversupply coming in the system. We've got a number of plants that are going to be retired over the next several years here, and that's just going to take away more demand domestically for coal. And in the export market, this is going to be challenged there because what we see with natural gas, what we're seeing with our renewables, and what we're seeing with other alternative fuel sources as we look at the economy going forward here. And so that coal story is going to be very challenged as we go forward here. Now, looking at on the petroleum, that's that left chart. That was an immediate effect, because immediately we all stopped driving. We all stayed home, and we didn't need to go and get fueled up in our vehicles. We didn't need to get the oil changes. We didn't need to do a lot of things. And so we saw an immediate drawdown of what was moving in a number of petroleum products on the system there, and that was very quick. Now, on the chemical side, it took a little bit longer for it to show up because there was so much momentum, there was still some productivity, and of course, we had a number of people transitioning in this economy to help support on the PPE side of things, as well as looking at how we need to start getting back into some industrial production here as we go forward. But its effect didn't really show up until a bit later into the summer. But now we've seen a good snapback here with the most recent data on the chemicals. And that shows that what we were talking earlier about that consumer out there. And we're seeing that the consumer is now driving or has fuel consumption at almost pre-pandemic levels. And we're not even into the official driving season, which what starts next week, or this weekend with the Memorial Day weekend that's coming up here. So we're seeing the potential for some great expansion of driving. People are looking at trying to get into an airplane, not so much for safety, but maybe have more of a darn mask. After being here, I want to get on an airplane and wear a mask after being together with y'all. But just to try to get all the airplanes brought out of the boneyards where they've been parked for a year, bring all those crews back and train, there's going to be a capacity constraint in the system out there. So driving we may see actually more demand for U.S. corn than for ethanol that may show up, and we're already penciling a lot more corn in our balance tables as compared to the U.S. government as we go forward here. We're seeing our corn supplies in the United States for the current crop marketing year dwindling fast. And it's certainly, as we start thinking about on the side of what's going on the covered side of the fleet here, it has been a healthy sector for the industry in 2020 and going into 2021 on the backs of trade will be resolved, or at least got phase one of the U.S.-China trade agreement. And we went and started seeing China buying a whole mess of soybeans last year. Brazil essentially ran out of soybeans, and the U.S. is harvesting, and China came and bought, and they hadn't stopped. In fact, they're starting to buy for new crop, and especially for corn. At most we've ever shipped to China on corn was about 7 to 9 million tons. This year we're forecasting 30 million tons. Next year, we're forecasting 26 or 30 million tons next year into China, and that shows a number of things with the changing of their hog herds, the changing of their dynamics of what they're producing. It may be, and imagine this, we show two types of, we have a chart, we show two lines on there. We show the world with corn ending stocks as an example. Here's the world corn ending stocks. And then we show the world without China corn ending stocks. Why is that? We don't trust China's data. And it may be the fact that China really doesn't have the corn stocks, and what stocks they have, whether it's corn or anything else, is not of great quality. And so they're seeing that demand is coming back, and they are now at a record pace. I think we're, as the United States, at a record pace for new crop corn sales, and that starts September 1 is when the new crop year starts. So going into the next marketing year, we're already onto a good pathway to achieve, it won't be a record corn export program for the United States, but we've got 2.6 billion bushels plugged in. This year we've got 2.9 billion bushels plugged in. Let's just say those are very high levels of corn exports on top of soybean exports that were 2.5 billion, I think, this year, roughly 2.4 next year as we go forward. Brazil's got a bad crop of corn, their winter corn crop right now.
And that's their biggest part of their corn crop.
They got a late in the winter, and as soon as you harvest their soybeans, they plant corn. If you add more soybean area, you get more corn in Brazil. It's kind of like a chicken. It comes with the legs. We all like the white breast meat, but not many people like the leg quarters. We export a lot of those. And so it's with Brazil, the corn comes with the soybeans. Well, this corn crop was planted late, and it's been very dry. It was at a potential of almost 115 million tons, 120. We forecasted at 93 million tons. We can see it going to 89 million tons. The government in Brazil is at 106 million tons. The U.S. government is at 102 million tons. They are way behind on looking at the crop down there. If we survey farmers and agribusinesses down there as we do in the United States, we think we've got some better intelligence. That brings business back to the United States. They're going to be importing corn from Paraguay and Brazil, and then we're going to start seeing some market opportunities, especially as we finish up this summer, and we start getting into the first quarter, the end of this year. We can see some very strong movements, not only of corn, and then soybeans. Soybeans moves pretty fast. Brazil is done harvesting. They're exporting a lot of soybeans now. They'll finish their soybean program. They're also, by the way, they're sending about anywhere from about 10 or so vessels of soybeans to us because we basically ran out of soybeans in the United States this year. And we start looking at what's going to happen next year. Brazil is going to be in a situation of a bigger soybean crop next year. We can see some balance around that. Now, the wild card in all this is what's going on with renewable diesel, what's going on with policy around having more vegetable oil to go into diesel. And by late calendar 2022, we could be short feedstock for renewable diesel. And we're seeing a great number of announcements for new crush facilities, whether it's for rapeseed or canola or for soybeans or for other ingredients. Any kind of tallow, any kind of yellow grease is going to be heading to the United States next year to try to meet that mandate for renewable diesel. Now, for next year, we're forecasting corn area to be 96.8 million acres. That's off the charts for everybody to try to absorb. And certainly the U.S. government is way behind on that number. Their next number will be the end of June. We get the plannings report. We've got our soybeans right under 90 million acres. That's a record combined area in the United States. And you put together a yield of 180 bushels for corn next year and about 50 bushels for soybeans. Let's just say big crops. You're going to have about a 16 billion bushel corn crop next year, and you're going to have 4.5 billion bushel soybean crop, I think, next year. You got something to move next year. If you look at this covered fleet, it had been fairly young. It's been starting to age. We saw a few retirements this last year, and what we did see is an uptick in some movements here. Part of that is related to the ag products that we're moving, and we expect that going to 2021 as we think about this fleet. If you look at that age, it's starting to creep back up here. You're starting to get into that fleet that was built in the mid-1990s that is getting to be long in the tooth. As we start looking at that and looking at some of those scrap opportunities that would be necessary there, we start thinking about rebuilding what would be those requirements as we go forward here. Could be very intriguing as we start looking at this global dynamic, especially on the ag side of things as we go forward here.
And I just want to touch back real quick on the coal side. The regulatory aspect for coal is not a positive one either in terms of power plant emissions, things like that. So there's another component that's going to enter into that picture on those that coal barge outlook. The other side to keep an eye on too, relative to the petroleum side and crude oil in particular, is on pipelines. We've already got the Keystone pipeline halted. That project halted. Dakota Access Pipeline so far is open. The Line 5 coming from Canada into the United States is still open, pending both of those court actions. If, for some reason, those pipelines get shut down, that shunts a lot more traffic over to the rails and eventually then barges. That I think could be a factor, just one of those wild cards to keep your eye on relative to what that barge outlook might be in the months and years ahead.
Certainly, and we've been seeing on, ethanol exports have been really ticking up here. Brazil will probably be taking some ethanol from us as they're transitioning away from a sugar diet for ethanol. They do have a bit of a corn diet now in central Brazil. Without any corn, they can't run their ethanol plants. And we're trying to see some relaxation down there. But you look at our supply and demand for the covered fleet, that's that left chart, where we index the fleet, we index the tonnage that's moved, and here I've got through 2021 on here, and you can see we've got still the demand for equipment is continuing to increase, yet we've got a stability in the size of the fleet as we go forward through 2021. And you look at, we take some I'm a longshoreman's kid, and I dare sometimes don't always want to admit from the West Coast. My family are in the ILWU. Someone said they're going to throw something at me earlier, so I'm going to do it now. I learned how to swear, but I swear I won't do it here from being around longshoremen. But we did simple arithmetic. So take one number, subtract the other. I can handle that. And that bottom line on the bottom here is our barge pressure index. And you'll see this in the next few charts here. And essentially, if that line is falling, that means the fleets are just under less pressure. Partly either the fleets are too big, or demand is falling off, or conversely, if the pressure is increasing, we should see freight rates increase, or we should see valuations percolate back up here as we go forward. And so on the right side, again, you can see where we're going to have record demand, we think, for covered commodities through 2021 as we go forward here. Now, if you look at the open side of the fleet here, removing the coal, a little head fake again this year. I can't emphasize that enough as we go forward. And we would suggest that it's a very, well, we don't suggest, the data shows it's an old fleet still. We came flat in 2019. We're starting to see it get younger only because we're retiring some of that fleet. There is a few replacements going on, but we would anticipate to see even further erosion in the number of open barges required in this fleet as we go forward. You're not going to have the coal as we go forward. The level of production will be about 570 million tons of coal this year, and then it's going to be, it came up from 556 last year, and then from here, it's going to crash right through 500 million and work its way down to 300 million, high 300 million tons over the next several years. That's going to be a very difficult environment as we go forward here. So looking at those types of challenges we're going to endure. On the tank side of things, certainly with what we saw just a little bit of a shrinkage in the fleet this last year, but nonetheless, when you look at the volumes are moving by tank, it held in there pretty steady. I think for 2020, we probably need to adjust that a little bit lower there. We don't have the official Army Corps data. They've had some issues trying to release their internal barge data that we use. They're 3 years behind right now. They're supposed to get it out this month. I'm hoping so. If not, we'll just have to keep running forward on estimating with the relationships with our demand that we see out there. But you look at the age of the fleet here, especially on some of the semi-integrated tows, fairly young fleet that we would see there. The jumbo barges have really expanded in size of fleet. They're steadying out on their age when you look at that. So we don't see as big a retirement, but it's more of an age-out sort of process there on some of the vetting rules that we see that drives a lot of the retirements and such as we go forward. So that COVID was very challenging on a number of fronts for people. So we look at the total barge fleet all together here, and we start thinking about the next couple of years here. The lines below zero, if you're colorblind, that's red. That's the retirements that we've seen over history. And then the top area, the green, those are the positives. That's how many new builds that we've seen over history, but then what we're forecasting coming here to 2021 and what we would see for 2022. We look at the world, these balance tables have got to balance. And we're looking at these, whether they're tonnage indices or they're ton miles. What's the average distance move on some of the equipment out there, the commodities are going, and we're looking at those trends. What does that, and looking at fleet by fleet by fleet, you look at the different types here. So we're seeing a new build environment just right around 500 barges here for the next couple of years. And then we start looking at, all right, if we start thinking about what's taking place here in terms of the metal pricing, one, to build a barge, it is expensive. When you look at that chart on the left side, steel plate. These are some prices that we forecast and have at IHS Market. We think we've seen the peak here. Anyone think we've seen the peak yet? And we think that we should start to see it drop down. These are probably 6 weeks old. And I'm sure we're going to see those change a little bit. We do have some history that shows a little bit of pull down, but it would seem that those wanted to stay a little bit more elevated. The scrap price of the equation here, to be able to get some of the values that we've been hearing on the scrap side have been very impressive, and certainly it'd be nice to be able to do that, except that now you got something to move. And you're doing those arithmetic exercises in the back of the envelope. Should I get another turn before I scrap it? Type equations there. And we see the age maybe of the fleet get a little bit older because we don't remove as many barges. But here's the environment. Because if you go back, remember 2018, we saw a great number of retirements early that year, especially the first quarter, saw very healthy scrap prices. And then it fell off completely. And now here we are back and surpassed those levels. And very attractive environment for some of that scrapping. And given the number of steel plants and other places that are demanding scrap, and as the consumer comes back, and as we start to get people working again, we hope that at the end of the day, we need a good immigration policy in this country. We need to find ways. We sat with this guy from Argentina the other day, and he said the United States needs to increase its population. If you think about China, 1.3 billion people, India, 1 billion. Hopefully they're going to be 11 billion people after this COVID thing. We need to probably be closer to 500 billion people in the United States here, up from our 331 million that we got today. If we start thinking about where we compete, how we need to be ready in the world, and to be that productive engine that we have out there. But if you start thinking about the summary here, we'll wrap up here and certainly want to take any questions that you have. But Roger, going through this macroeconomics, it's got legs as we go through here.
Yeah, and as we pointed out, consumers do have cash. They're sitting on a bunch of it. As they start to get back to work, you're going to see wages rise. You will see that. You're already seeing, businesses try to attract workers back from the unemployment rolls by offering some pretty decent wages. I've seen more than a few fast food places talking about $15 an hour plus just to get someone to come in and work. And I think the other biggest challenge is not only getting them to come in to take the job, getting them to show up for the job once they have it. That's the other key, I think, that's going on here. It's taking a while to get through. But as consumers have come out of this COVID, they're sitting on, again, a repaired credit situation. They've got big savings, and they're getting tired. They want to get out and do things. And I think that is a factor moving out. The policy and trade mix, right now, I don't think we're seeing a great big change on the trade policy from this administration. They're not making a lot of changes. I think the USTR is taking some time to get up to speed. Catherine Tai is U.S. Trade Representative. And we'd like to point out some of these people that are in key spots because people drive policy. And that's the important thing always to keep in mind. Ms. Tai is very experienced in the U.S.-Mexico-Canada agreement, and because she was the general counsel for the House Ways and Means Committee when that legislative package was being finished up, so she knows that part of our trade policy extremely well. And I think that's going to be potentially a key for her moving forward. We've talked about coal. I want to point out two lawmakers then. As the fortunes of coal continue to decline, there are going to be two lawmakers that are going to be sort of kingmakers. One of them already is Joe Manchin, West Virginia, Democrat. He is one of the keys. He doesn't want to get rid of the filibuster. He's been, I won't say a thorn in the side of this administration, but he's just a little bit of a bump that they don't like walking around. And he's going to make sure his coal interest in West Virginia are taken care of. Shelley Moore Capito is a Republican from West Virginia. Notice she's been taking the lead on the infrastructure negotiations. So I think you're seeing a couple of things thrown towards West Virginia that might be a recognition of the declining fortunes that are ahead for coal. And I think that could become, those are probably two lawmakers that you need to watch very closely. Manchin in particular, just because he's that potential key vote in the U.S. Senate when you get to a 50-50 tie, or to get even to a 50-50 tie. If he's not on board, then something isn't going to happen.
Meanwhile, if I skip down and look at the grain and soybean exports, we think about the river system, how tremendous it performed this last year. We had a record U.S. grain and soybean export program, and nobody goes. And that just shows that rooted in the resilience that you have as an industry. Now, it mattered that we had decent water levels going for sure through the lower Mississippi River, and that was very important with fully loaded vessels to the draft that they can use to go to destination markets, and that just keeps them very competitive. And certainly as we look longer term, we get the 50-foot, maybe not so as much as important for grain from the standpoint that you don't need as many vessels to go to 50 feet, but it's still very important nonetheless, is that you get the consistency of the draft. And not only that, you can fully load those, and those vessels would either go through the new cell locks, the Panama Canal, which I think I count in one hand how many grain ships have gone through there. But it's been ro-ro ships, it's been LNG, it's been container ships that have gone through there. And then secondly, on the grain export front, on the lower miss, that many of those export elevators have done a number of enhancements in the last 2 years. And there's a couple more projects that were just announced and underway to improve the efficiency of the facilities, to modernize them, and when they do that, they get more efficient, they can run at a lower price, and get better margin, but that means attract more volume to them. And then there's a permit being drawn for a brand new export elevator in the lower Mississippi River area to handle upwards of 11 million metric tons. That is no small export elevator. So again, the river system has some room around the grain that's coming forward here on the exports in the long run. At the same time, don't dismiss the Canadian battle going on for the Kansas City Southern Railroad. The Canadian National Parallels and River System, having access to the Kansas City Southern will certainly give them a bigger benefit getting into Mexico. We could see some of the Mexican business out of the U.S. Gulf that would go waterborne that could end up going by rail if they are competitive. The railroads have one way that you negotiate with them. I don't know if our railroad friends are in here. You just knock on the door and say, hey, I'm here to negotiate. And they say it will be 15%. And you say, thank you very much, that's not 20. And you go home. And so you see with the railroads, how are they going to compete? And could the CN find itself in a position to compete with the river system as we go forward here? I think that's going to be, if they are the successor, and if the Surface Transportation Board approves this process as we go forward here. I'll run down to the very bottom point here, the carbon sequestration. It is important and getting more important, and you as an industry have a favorable story around that. The amount of tonnage you can move with 1 gallon of fuel should not be overlooked. It needs to be championed and paraded all the time. Go back to the Brazilians. Follow the Brazilians on Twitter. They're watching the work that we're doing here, and they're saying, why not us? Why not take those trucks off the highways, lower their footprint on carbon, and try to make the improvements? When they make those improvements, become more competitive, lower cost, less sequestration in the system here. It's better for everybody around the world, but the competitiveness and infrastructure matters, and to support the rolling and floating assets that we have in the United States.
And with carbon sequestration too, this is a government-wide policy for this administration. But I think it's important to know that this process is going to unfold over years and may well take beyond this administration, 2 administrations. I'm not exactly sure how long it's going to take for what concepts that are being talked about now to actually result in impacts all the way down to the consumer, to the farm level, etc. You know, when you talk about agriculture production, it's the Wild West when it comes to carbon sequestration. And there's a lot of things out there. And I think, as you know, with any industry, be it agriculture, when you have these private carbon markets coming up, I implore you, read the fine print in any contract you get into, because that can be very important for your long-term sustainability as a business. So there's going to be a lot of things coming at us over the course of the next few years, and those things are going to change how we do business, but the speed and the trajectory of that is not at all clear yet at this point.
Well, great. Well, with that, we're happy to take questions. If you want to just raise your hand or stand up, give your question, we'll replay it here for everyone to hear. So, I think we got time for some questions.
My name is Lincoln, Eastern Shipbuilding. What you just said about the carbon sequestration, that would make sense for the Biden administration to prioritize the river infrastructure system due to that sequestration, but it doesn't appear that that's the case.
Lance, right? And Lance was asking a question around the carbon sequestration. The Biden administration really making a push, and it really should lend itself to support the inland infrastructure, waterway infrastructure, and to support that because of the benefits of that. And I'll say this first, you're exactly right. And I would also suggest that you go back to the Biden administration and the Trump administration. Where did they go announce their infrastructure plans? On the river, in a river city. So that's encouraging. You actually are hearing the word rivers, even waterways being mentioned. It's not strictly a highway or a bridge program. Again, I'd like to see a bridge in Memphis fixed. I think I'm safe to go over it. But I think you're exactly right. It's a very important feature. And that's something, again, those people leading the negotiations and to try to, as an industry, you've got great industry partners, whether it's the Waterways Council Incorporated, Paul Brody will be here, I don't know if he's here right now or not, later today, and then you've got American Waterways Operators, and all your commodity associations that really support that. But how do you get that to be advocated even more so? Because I can tell you, I remember showing our numbers in Europe one year, comparing Brazil and the United States on the amount of carbon that Brazil emits when they take, say, a pound of anything, and we showed it, and all the people in the front row that were European, their mouths dropped. They didn't have an appreciation that way. Your waterway industry is most efficient that way, and that story needs to be told.
It needs to be told, and that's where I was wanting to go on this. And it behooves everyone in this room. Reach out to your elected representative. You know, you're probably going to end up dealing with their staff, and truth be told, they're the ones that really do a lot of the work. But get your message across. Communicate effectively, you know, with facts and figures to back up what you're talking about, okay? That is how you're going to help move the needle on this. If you get the buttons pushed, if you get the push on the lawmakers, that push keeps going up to the administration and through the regulatory process. That's how it can be effective. So it's important for everybody to try to become as effective communicators as you can be in trying to tell the great story that your industry has, especially when it comes to this carbon sequestration issue. You know, that's probably that could be one of your biggest calling cards in going to deal with lawmakers, especially those of the progressive wing of the Democratic Party and others, to say, hey, look, we're already doing this. We can do more, but we need your help to do it.
Other questions? Dave.
What's going on with the steel tariffs? Are they still in place?
Question from Dave around the steel tariffs. Are they still in place?
Yes, they are still in place. The administration is giving no signal yet that they are going to pull them off. I was noticing that on Ken's chart on the steel price situation. Those are not being pulled off, and you're starting to see a focus by this administration, more of a focus, on overcapacity. Read that, China. Okay, when you hear the term overcapacity in steel production in the world, they're talking about China. They just don't come right out and say it. So far, the Section 232 tariffs are not yet being removed. Where the pressure points are going to come, you've got the UK already talking about increasing some of their tariffs against U.S. wines, some other goods starting around June, starting in June, I believe it is. So that can start to bring some more of the pressure to get those tariffs at least reduced, if not removed. But the steel industry, of course, is making a case because they're starting to open some facilities. They're starting to rehire some workers. So they're telling the administration, look, we're just getting this industry back going again. You've got to leave these things in place. So I don't think you're going to see an immediate removal. I think your best hope right now is going to be get them reduced unless we get some changes made to the U.S. Section 232 law, and that's a lot heavier lift than I think anybody would like it to be at this point. So right now, those are not going anywhere.
Libby.
Yes. I realize that standardized actions are a fairly small percentage of the total market, but due to COVID and because of shortages of containers, a lot of the actions have been left because they're shuttling the containers back to headwall markets without great backlogs. What do you see as the impact? Is
questions around the use of containers, especially in ag, and what that looks like in the massive disruption that we've had this year, and looking at what could this mean going forward here. U.S. grain and soybean exports are at most 8% on a weekly basis moved in a container. Otherwise, it's mostly moved onto an ocean vessel, and there's a little bit that goes over the border into Mexico already, and a little bit into Canada. Then there's so that's maybe 150,000 containers a year. And then on the product side, distillers, dry grains, and solubles, soybean meal, corn meal, flour, and such. That rounds out probably 250,000 containers on that side. There was a lot of shortages, and this year people are trying to find any kind of thing that can be consumed by an animal. Poultry fat to poultry feathers. They're trying to find them. We have people from all corners of Europe looking for those, but the problem was they couldn't get containers. We think this is going to be a problem that will persist well into the fourth quarter this year. There's a great slug of new containers that are being built in China, in particular, and they'll be available for around the start of third quarter, right ahead of our leading into peak season for back to school. And then for the holiday season, you'll have a number of containers, but until then, we see some shortages and some challenges on ag. We think there are going to be some opportunities around that. The challenge is, what is that going to look like long term? It's a good question, Liddy, but I think maybe we'll get some of these things to balance out here. But what will the carriers look like? They're all making money this year for the first time probably in ever as an industry. And they'll probably go out and build more ships or get more containers, and you'll be right back to where they'll be losing money again. It's just a matter of how much they lose.
And the Maritime Commission hasn't finished up their investigation of everything that's going on just yet. To me, that probably, it may not move the needle a great deal, but probably could free up a little bit of some of that space that's been, neglected and backhauled empty, as we were talking about.
One more question. Yeah, we can. If you don't mind, Lydia, we can catch up later on that. We get one more question on the waterways here. Yeah, Nelson.
Is the increase in coal demand export or
Yeah, questions around the increase in coal demand right now. Is it for export or is this domestic? It's both. We've seen some good pricing overseas for U.S. coal, and we've also seen on the met side, and then domestically, we've seen with the price of natural gas here recently that popped up. We saw the rapid expansion of the economy in various areas that needed more electricity generation. Coal was able to come in and fill that, and that will get us probably through most of 2021. But as we get to Q4 and going into Q1 next year, that's when we start to see the domestic side start to slack off. So, all right, I said one more. I'm going to grab one more, so we'll get right in.
Good morning, Ted.
Good morning.
Hey, talk about the increase in the crop production going forward. But we really didn't talk about the inputs. I'm curious what your opinion is on specifically fertilizers, both domestic.
Good, great question. It's around the inputs for ag production, so chemicals and fertilizer. Look, at these prices where we are with corn, at these prices where we are with soybeans is not a big fertilizer consumer. The farmer's going to buy as much fertilizer as they get their hands on. The question is, can they get it? And right now we're seeing a lot moving here. The price has gone up considerably. We know this much. When you put fertilizer on, that's yield enhancing. And then we got the crop in early, relative to the past couple of years. It's a little bit dry in some areas. We've got some timely rains most recently here. Farmers are getting this fertilizer on. The field work is taking place here. They're happy to put it on at the maximum rate that they probably can do that because they know it will be yield enhancing. Those who've got tile in, if they get a lot of rain tile, when it rains a lot in low spots, the water runs down to the tile, and that tile is underground, perforated, pulls it away. That's yield enhancing. And then those who've got those circular pivots for irrigation, that's yield enhancing. They're going to be running all things this year. And just watch the equipment manufacturers. Farmers are going to be buying a lot of equipment. They're going to be buying a lot of F-150s. I don't know if they're going to buy a lot of the new electrical ones. That may be a taboo thing for a farmer to do. But you start looking at those equipment. Farmers can't buy equipment. because the supply chains are so broken up. You've got the delay in parts, let alone the chips that you see out there. So you've got a lot of challenges that are out there. The farmer's going to be doing a lot of tax planning this year. They're going to get a lot of revenue. When they get out to the fourth quarter here, they're going to try to bring a lot of expenses forward here to minimize their tax burden as they go forward.
And your question on the fertilizer price side, usually there's that 1 year lag. If we get into an oversupply situation on corn and that corn price goes down, the farmer immediately starts trimming back their inputs, and that's usually comes in a year when those fertilizer prices have gone up and up. And then there's that 1 year that low corn price hits, that trims demand, that builds supply, that brings that fertilizer price back down again the next year.
It's always a pleasure to be here. You all are great folks. You're rooted, you're resilient, and we've got momentum to go forward here. It's a privilege to be with you, and we look forward to the Achievement Award that will take place here. Thank you. We'll be around, and I look forward to catching up with you.